Property Hotline with me, Suesha Samant, on India's first property business channel, Magicbricks Now. As you know, this is the show where we try and get you answers to all your questions related to buying or investing in property and its various aspects like legal, tax and home finance. On today's show, we'll be answering tax queries with our expert for the day, Bhairav Dalal, Partner Tax and Regulatory at PwC. Hi Bhairav, welcome to the show.
Thank you. How are you doing?
I'm doing perfectly well and we'll be answering tax queries today.
Yeah, looking forward to it.
Perfect. Before we start, you know how you can reach out to us. You can call us on the numbers which are on the bottom of your screens. We'll take your questions live, or you could also write to us on the addresses which are mentioned on the bottom of your screens. With that, we get started and move to the first question, which is coming via email by Neerav Joshi. Now, he is asking us, what are the taxes applicable while buying a new or a resale property? If the developer has not paid any taxes, can the authorities demand taxes from the flat owner?
Okay, so I think the first part of the question is quite broad in the sense what are the various taxes, and the list of taxes never end.
Of course.
So let me just summarize the ones which hit the pocket the most. To start with, there's obviously stamp duty which the purchaser has to pay while he's buying a flat or a property. The other taxes are you end up paying a service tax and VAT. Now, service tax is a central levy, so anywhere in the country you buy a flat, you have to pay the tax. Whether it is VAT, the VAT depends state to state. So, in whichever state this gentleman is buying the flat, it depends upon the regulation of that particular state.
Okay.
It could vary from 2% to 6% depending upon the state in which he's buying the flat. The other tax, which is effectively in the nature of TDS, which is 1% when you make the payment to the developer. Now, the service tax and VAT essentially are when you're buying an under construction property.
Yeah, this is exactly what I was going to ask.
Yeah, if you're buying a property in resale, then both these taxes are not applicable. But the 1% TDS when you're making the payment still continues. And the stamp duty obviously is there as well. So these are broadly the taxes which, when you are looking at purchasing a property, you have to factor in.
All right. And to answer the second part of his question, which says that if the developer has not paid any taxes, is it that the authority can demand it from the flat owner?
So if you have proof that you've paid the tax to the developer and he has defaulted in making the payment to the government, I think it's very, very, very rare that the tax authorities will come and demand again from you. Although there are some provisions under which if you have not taken the possession of your flat or property, technically the tax authorities can still take over the possession and you don't ultimately get the property till the tax is sorted out.
Okay.
So not directly but indirectly the tax authorities may still end up recovering the tax from you.
Oh, so that can happen?
That can happen, but it's a very, very rare situation, I would think.
Okay.
And a very, very technical situation. Practically I haven't seen it happening in the last 20 years of my tax career.
All right, Neerav, I hope that answers your question. Mostly, the situation does not arise where the authorities demand the taxes from the flat owner directly, but there is a one-odd chance when that might happen. And with that, Bhairav, we'll move to our next question, which is coming to us on Twitter. It has been sent in to us by Ravi Tiwari. Now, he asks this question saying, what is the difference between TDS and income tax? Now, this is a very common question that a lot of people usually ask. Also, he wants to understand if TDS is the same as income tax. Now, TDS obviously is tax deducted at source. Yeah. Is it the same as income tax is what he wants to understand?
So basically the entire technical concept is the TDS is a term used when you are making the payment.
Right.
So when you're making the payment, you need to deduct tax on someone else's behalf. That is technically termed as TDS. I mean, when you are employed and you receive salary at the end of the month, the employer deducts tax, which is technically your liability, but there's an obligation casted on the person making the payment.
Right.
So it's nothing but income tax, which you end up paying for someone else, right? So that is really tax deducted. So effectively it's the same thing. TDS is a part of the income tax. TDS is a concept which the person making the payment has to do.
So the TDS anyway gets deducted.
Absolutely.
And it is a part of the income tax.
It is a part of the income tax that you have to pay. So when you're purchasing a property, for example, you do a 1% TDS. Now that 1% TDS is nothing but the tax liability which a developer on the profits that he makes has to pay. But a 1% of that is what you are paying at source to the government. So the TDS as a concept helps government to collect taxes at source and not wait for the person who is actually getting the income to pay the tax later on.
Right, I hope that answers your question, Ravi. We'll now move to our third question, which comes in from Divakar. Now, he has sent in his query via email saying that he has purchased a 1 BHK flat and the possession will be in June 2016. Now, he wants to know if he sells this property after 3 years, will the gains from this sale come under tax deductions or not? Also, he wants to understand how much tax will be deducted.
Okay. So, since it's a very futuristic question, I don't know what will be the tax rate at that point of time. But assuming this property was to be sold today, or if we have to apply today's rate on this transaction, there will be a deduction of 1%.
All right.
On the sale of this property when the purchaser is making the payment. This is assuming that the person mentioned here is not a non-resident Indian.
All right.
If the person is an NRI, the TDS or the deduction will be at 22%.
Okay.
So it also depends on whether you are a resident or non-resident. The tax rates are dependent upon that as well. So as I said, if he's an NRI, it will be 22%. And if he's a resident, assuming the tax rate remains the same, it will be 1%.
Now, before we move further, I wanted to understand this 3-year period that you calculate. You calculate from the point, when you have signed the sale deed, or from the point when one has received the possession?
I think so there's a technical debate which always happens around this point. I think from a tax perspective, as far as an individual taxation is concerned, it's safe to assume that it starts from the day you signed the agreement and registered it.
All right.
Right? If it's only an MOU, then I don't think so you can take that view.
All right.
So if there's a proper sale deed or a purchase deed which is registered and full stamp duty is paid on that, then I think it's a relatively safe view to say that my 3-year long-term date starts from that. Although if you want to be extra safe and completely conservative, also do a calculation from the date of possession.
All right. So whose hands is it in, like?
So it's really the tax authorities who will take a final call.
Exactly.
So at the end of the day, if they don't agree to this, because there's nothing written in black and white.
All right. All right. It's variable. It depends on the tax authorities.
Yeah, it's in a little bit of shade of grey. Now, depending upon what suits the tax authorities, they might end up taking a view that it is from the date of possession and not from the date of agreement.
Right. Right. I hope that answers your question, Divakar. With that, we move to our next question, which is coming to us on the phone.
Hello.
Hi. May I know your name, please?
Hi, I'm Arjun. I'm calling from Pune.
Yeah. Hi, Arjun. What's your question?
I'm an IT professional. I'm eligible for a home loan of around 70 lakhs. So I have identified a property that comes to around 40 lakhs.
All right.
So I wanted to know if I close the deal this January, will I be eligible for tax deduction in this financial year?
Right. So he's eligible for a loan of 70 to 80 lakhs, but he's identified a property which is 40 lakhs. Now.
Yeah. So I'm assuming if you take the possession in January, you'll end up paying 3 EMIs for this year, which will be January, February, and March. A large portion of those EMI will obviously be interest, and if this is a property which is completely ready and you take possession, then you should be able to claim interest for 3 months. That's not a problem at all. If you don't take possession, or if the possession is not being given to you in this year, or you have only purchased the property, then you have to really wait till you get the possession of the property to get this interest as a tax deduction against your income. So,
right.
Although we didn't get clear thing about whether you're going to take the possession or not immediately.
Arjun, are you going to take the possession immediately?
I plan to take possession immediately. So I should be getting possession by, say, this month or next month.
Yeah. So your tax deduction on interest will really start from the day you've taken possession. So any interest you pay after that date will clearly be allowed as a tax deduction.
So it is after the date of possession. All right. I hope that answers your question, Arjun.
Yes.
All right. Thank you so much for calling in. Right. We now move to our next question, which has come to us from Jay via email. Now he says that he has booked a property that will be delivered in February. Now he has declared it as an investment. He wants to know, will he get tax redemption on the interest paid? And also he wants to understand, can he declare rent for 2 months or should he declare it for the entire year?
So effectively, he's getting the possession this month, right? That's what the question said. So if they're getting the possession this month, I'm not sure how you can declare the rent for the entire year.
That's in February.
So if you're getting in February, effectively you can show that this property was either leased out or there's a concept of assumed lease out, the deemed let out property concept. But that you can show only for 2 months because before that you did not even have the property in your possession. So it's not going to be possible for it for the entire year. Like we answered in the previous one, if you have paid interest before the possession, you get it, but you get it as installment for the next 5 years, 20% each year. Anything post possession, you get it in as and when you pay it. So post February, whatever interest is paid, you will get a tax break for that. Pre-February, whatever interest you've paid, it will be available to you for the next 5 years in 20% each year.
There's a sense of confusion for me in this question. What I want to understand is that when he's talking about the property, he's talking about this house that he's bought.
Yes.
So 2 months, he wants to understand whether he should declare the rent for 2 months on the property on which he'll get possession in February.
Yes.
All right.
So I think there's somewhere an assumption in the question that this is not his first house. This is the second house.
All right.
Which is where you typically, if you have one house, which is where you're staying, and the second house which you buy, either you can put that house vacant or you can put it on rent.
Right.
Now, the assumption in the Income Tax Act is even if you put it vacant, they will assume that it is let out to someone and they'll charge tax on that.
Oh, okay.
So that's why he's asking that question, whether 2 months rent should be declared or not. Even he doesn't have a choice. He has to declare rent for 2 months. The rent is calculated based on standard rent for each area. Like we have a rarely reckoner value for each area.
Right.
There is also a Rent Control Act, which defines each area what is the standard rent. So based on that standard rent, he needs to calculate what is the assumed rent that he would have earned here.
Okay.
And against that, he'll get the interest as a tax deduction.
Right. But like he said in his case, he should do it for 2 months or for the entire year?
He has to do it for 2 months because he can't do it for the entire year because he really didn't have the property with him. So his period for giving that income starts only when he takes the possession.
All right. So it usually always starts once.
Correct. The next financial year, he can show the full year.
All right, I hope that answers your question, Jay. Thank you so much. With that, we move to our next question, which is coming to us from T. Gopalan. Now, Bhairav, he says that he is in the process of selling his property. He does not wish to invest in another property. He wants to know if he can invest the amount gained, whether that can be invested in mutual fund. Secondly, he wants to understand, will it attract tax? And the sale of property, the gap is 20 years. It's after a gap of 20 years.
So if it's after a gap of 20 years, clearly it's long-term capital gains. There's no doubt about that. He'll get indexation benefit and his tax liability will be appropriately calculated. The question whether he can invest in a mutual fund, obviously he can invest in a mutual fund, but this investment with a mutual fund will not give any tax exemption on the capital gains.
Okay.
It's not long-term capital bonds or not any other property. Unfortunately, today, the way the Income Tax Act is, if you have a long-term capital gains on sale of a property, you can invest only in another property for the capital gains to be exempt, or you can invest in those specified long-term capital gains tax bonds. Now, mutual fund has not been included in that section, although I am aware that the entire mutual fund industry has been asking for this for a long time. Maybe this year's budget, the finance minister listens to the mutual fund industry's request and includes the mutual fund, but the way the law stands today, even if he invests in a mutual fund, the tax benefit is certainly not there. So he will have to pay full tax at 22% on the long-term capital gain he earns on the sale of this flat.
So in a case like this, where one does not wish to invest his proceeds into another property, are there any other ways of saving on long-term capital gains?
No, there are no ways. So the law clearly defines that if you have sold a property, and if you want to take benefits of the exemption, then there are specified assets in which you need to invest. As of now, as I said, there are only two assets. You invest in another property or you invest in long-term capital gains tax bonds. Now, mutual fund may be there in the future. Actually, a couple of decades back, something like this was there as a part of the law, but I think it's got amended some 20 years back. Hopefully, next February, we have something again to this effect. It will help the mutual fund industry as well. It will give another option for the people who sell their assets to invest the money in mutual fund and not in a illiquid asset, which is again real estate.
Which is this February,
This
2016?
February, yes.
All right. So hopefully we're expecting a change.
Yes.
All
Yes.
right. All right. So I hope that answers your question, Mr. Gopalan. Ideally, if you want to save on long-term capital gains, you should either invest in a property further. If not, then in long-term capital gain bonds. All right. Thank you so much for writing in to us. We'll now move to our next question, which comes in from Dinesh via email. Now, he says, what are the tax implications on selling a residential property inherited by 4 legal heirs from their father, who is no more? And also, he wants to understand how can the taxes be saved?
So, in inheritance, you typically go back and look at the total holding period.
All right.
So, if the total holding period is more than 3 years, it will be long-term capital gains. The way taxes will be computed for all 4 who have inherited this property will be depending upon the inter-se allocation between them. So, assuming each one has an equal allocation, everyone will have to pay 25% of the tax liability. Now, if you want to save these taxes and you don't want to pay these taxes, then you have the same option of investing in another property to the extent of your share of gain.
All right.
So, if the total capital gains is 100 rupees and your share is 25 rupees, to the extent of 25 rupees, if you invest in another property, that person individually can save his tax liability. If all 4 of them do, there is no tax for all of them on this transaction.
So either they have to hold on for 3 years.
Yes.
Collectively.
No, not this asset. So this asset will get sold immediately is
All
what
right.
his question is.
Yeah.
Whatever they generate from the sale proceeds, each of them will be taxed depending upon their individual share in the overall property.
Right.
Assuming they all have equal shares, which means 25% comes to each one of them, they will need to use this 25% and reinvest in another real estate asset, which they need to hold for 3 years. So each one will have to invest in individual assets.
Right.
Collectively, they can invest in one single asset again, but all 4 of them will have to stay invested in that asset for the next 3 years.
One more thing I wanted to understand, that in a case like this, from what date is it calculated? From the date of when the property was inherited or from the time when that property was bought?
No, so it gets calculated from the date when the property was originally bought. So in case of gift or in case of inheritance, from an income tax act perspective, you need to go back to the date of acquisition from the original holder. So if father, in this case, who has bought the property, let's say in 1980, then it will be calculated from 1980.
All right.
And if he had bought in 2014, then it will be calculated from 2014. So you have to club both the periods to come to whether it is more than 3 years or not.
All right. All right. All right. Thank you so much for answering that. Our next question comes in from a live caller. Hi.
Hello.
Hi. May I know your name, please?
Yeah, this is Prasanna here from Pune.
Yeah. Hi, Prasanna. Welcome to Property Hotline. What's your question?
Yes, my question is, if I took a property and make my wife also as a co-owner, and if I took a joint loan against me and my wife's name, so can we both claim a 2 lakhs each interest deduction as against income tax? And does it matter who is actually paying EMI, or do we actually need to pay half of the EMIs?
What do they do in this case?
Yeah. So the interest deduction is effectively available for someone who has taken a loan to purchase the property. Right. So in this case, as you mentioned, both of you are going to take the loan, and it's going to be a property in joint name. Both of you will have to pay the EMI and bear the interest burden. Only then it will be effectively 2 lakhs each in the tax return. If you pay the EMI and your wife is only a joint holder for the property, then she cannot separately claim the tax redemption on the interest paid, because it's essentially not paid by her. So you will have to split the EMI between both of you, and both of you will have to pay the interest.
Right. Does that answer your question, Prasanna?
Yes.
All right. Thank you so much for calling us.
Thank you.
All right. We move to our next query, which is coming from Ramesh via email. Now, he says that he and his wife work for the central government. They draw a total salary of 60,000 rupees. Now, he owns a flat and has just finished repaying the housing loan for the same. He also has an ancestral property that gives him a rental income of 72,000 rupees per annum. In addition, he also earns through the stock market. Now, he wants to know if he can buy another flat for investment purpose and take a housing loan for the same to save tax and also earn rental income. Or the other option is if he should invest in land to get investment appreciation for certain years without any income tax benefits. I'm sure we're going to get a lot of those questions after the 7th pay commission, because the salaries have almost doubled and,
Right. So, whether to invest, whether to buy land or whether to buy a flat, it really depends upon which area you're looking at, and that's really an investment decision as against purely driven by tax. As far as the tax portion of the question is concerned, if you buy a property and you lease it out, and if you have taken a loan for that property, you definitely get tax break against that. So that's always a good strategy to optimize your tax, because you have borrowed money, you're paying interest, you might as well claim a tax break of that. And if you're earning rental income, and in some cases the rental income is not as much as the interest that you end up paying, so from that particular property you end up getting a loss. Now that loss can technically be set off against other income, which I saw he also has some investment income. So technically you may be able to use that loss and offset against your other income and reduce your overall tax burden. So that's something which certainly can be done. Buying a land, always a good option, because in the long run land always appreciates, but land doesn't have any tax benefits attached to it. So there's always a pick and choose that you need to do, and the cost benefit analysis you need to do at the end of the day.
From the commercial aspect, whatever suits his pocket better is something that he should opt for. Right. Thank you so much, Ramesh, for writing into us. With that, it's time for us to wrap today's show. Thank you so much for joining us today. We hope to see more of you on this show.
Sure.
With that, like I said, it's time for us to wrap today's show. We'll see you tomorrow at the same time, where we'll be taking questions related to home finance. You know how you can send in your question. You can either call us, we'll take your question live, or you can write to us on the addresses which are on the bottom of your screens. Thank you so much for watching, and have a great evening.